Hey, it's Wayne from Visionary Wealth Management, and we do our best to stay in contact with you when markets are going up and there's not a lot of anxiety and stress in the world. But when markets are going down and plunging and there's a lot of anxiety and stress and frustration, we want to err on the side of trying to over communicate. And so this past week, you saw a video, kind of an extended video from me talking about kind of some of what's setting the stage for the two sides of the ledger in the United States government, trying to cut expenses and costs on one side while the administration really needing to put numbers on the board in terms of revenue on the other side. And they're trying to do that through tariffs, taxes, and trade. So the big three T's. So trying to bring trade deals that favor the U.S. back in vogue to balance some of the imbalance of international tax imbalances between what U.S. companies pay foreign countries versus what foreign companies pay the U.S. government, and then the tariffs, and trying to wean really the global economic system from having so many taps into the economic veins of the United States as the U.S. or as the largest economic power and the largest market in the world. So now the question really is, okay, the market's in free fall. What do we do about this? And I want to remind you of what happened in early 2020. So the market dropped about 36 to 38% in about 6 weeks going into COVID. And you'll recall that right around that, in the March timeframe, I sent out a video and I said, listen, just to let you know, we have taken a third of all of your conservative money that's liquid, that's available within your portfolio, and we've moved it into equities. And at the time I said the next step is if we go down another 15 to 20% from here, we will take half of the remaining and we'll do that again. And then if we go down another 15 or 20% from there, we will do it again. Now, we ended up doing that first round of buying right around the time the market bottomed, and we never had to move to phase 2 and phase 3 of that plan. And so what I want to do is I want to reflect back on that and say that behavior and our behavior then and our behavior in 2008 when things crashed informs our behavior now. And this is not the end of the great American experiment. This is not the end of the U.S. markets. This is not the end of U.S. economic dominance. And if anything, given the backdrop of AI and millennials aging into their peak earning years and all of the rest, the next 20 to 30 years of the American economic dominance is going to be more powerful than the last 30 years of American economic dominance. And so we are in a situation right now where the markets are reacting emotionally to unknowns and uncertainty. We are also seeing things like floating rate debt is falling in value and interest rates are rising on that. So super safe government debt, money's piling into that and interest rates are coming down on that side. But on a lot of bank loan debt, interest rates are actually going up and prices are falling. So that's, the potential to create a bit of a debt crisis, which we're very focused on and very worried about. But in terms of what we're going to do, the first thing we're going to do is we're going to take a breath. And we're not going to make rash, big decisions. You're not going to see us moving huge chunks of your net worth or your assets out of the market into cash or other things unless you call us and demand it of us. Why is that? Because in general, we own high quality, high cash flowing businesses. We were not and are not overweight the most expensive tech sector investments. We own many of those companies, but in relatively small percentages across the portfolio. And so there's not a need to move huge chunks of your net worth out of harm's way. Number one, if you have years to retirement, you have time to recover, and this market will recover. This market is not trading on fundamentals. Corporate earnings are not down. The jobs number we got last week was 100,000 jobs over what was expected. Interest rates at the federal level are coming down, not going up. So this is not and we don't have a full-blown debt crisis at this point. This is not a 2008 type situation where all of the mortgages where asset prices are down and mortgages need to be just blown out or refinanced, or houses recollateralized. So we do not have a 2008 type situation. We do not have a 2020 type situation, but we do have a lot of uncertainty in the market. So the first thing we're going to do is we're going to take a breath. We're not going to make big, rash decisions. The second thing is the way we have been positioned has us a bit insulated between our exposure to fixed index annuities as a bond alternative, means that we're not heavily invested in any bond assets that would be losing value at a time like this, number one. Number two, our bias towards dividend raising stocks or dividend increasing stocks. Those stocks through this week were flat year to date. So the big seven companies had dropped by a few $1 trillion in value coming into this past week. And our dividend stock portfolio just turned negative year to date on Thursday with the drop on Thursday. So we're not down, the portfolios are not down 10, 15, 20% off their highs. Numbers are down, but in the aggregate, your portfolio, your net worth is not down in line with the market right now, because we have been properly allocated, because we have been diligent. So the first thing we're going to do is take a breath. The second thing we're going to do is look for opportunities. And so that's going to come really in two ways. Number one, take liquid money, cash on hand, bonds, and or free withdrawals from annuities, and use that money to move into equities, number one. And then number two, in terms of the kinds of equities that we own, take a bias, perhaps a little bit off of the dividend growing companies towards the tech-centric or some of the other names that are just getting absolutely demolished. And so, and there's lots of names on that list in terms of companies that are getting demolished. The other thing we'll be looking at is those floating rate bonds, where we typically have had a little bit of exposure to that asset class. We will likely increase our exposure to that asset class, because that's an asset class where when things get really disrupted during a period of time like this, the interest that we can gain, we can frequently get paid 10, sometimes 15 or 20% a year based on the value of the underlying assets and the yields on those bonds, because the value of the bonds have dropped. So we will be looking at, number one, does it make sense to take liquid money and move it into equities? We will be looking at where does it make sense to change our bond allocations towards more floating rate bonds. And we'll be looking at taking money that's perhaps already in equities, but shifting kind of how much octane or how aggressively positioned we are. So those are the three categories of how we will approach rebalancing funds over the course of the next few weeks, watching what goes on in the markets, watching for signs of stabilization. We're already having a number of countries come back to the table and say, hey, let's talk about this tariff thing. Maybe we can go to a 10% back and forth or a 0% on some stuff. So we're already seeing in just a few days here, countries willing to come to the table. And you heard, if you're keeping an eye on the news, you heard some things that ideally the goal would be to have a global 10% tariffs back and forth between countries, or perhaps even large free trade zones that exist between like the US and Europe, or the US, Mexico, and Canada. So, but having widespread large free trade zones. So those are some of the things that we are anticipating to see as things maybe stabilize a little bit. As always, we're here with perspective for you. We're here to help you accelerate your vision for your future, and we're here to help you make great decisions within your portfolio. I hope this is helpful to give you just a few things in terms of how we're thinking about this. Number one, breathe. Number two, look for opportunities to invest in equities. Number three, look for opportunities to add octane or aggressiveness in the kinds of equities we hold. And as the market deteriorates, these are the seasons, these are the times where the market gives us opportunities to buy great companies at value or devalued prices. And this is not the end of the American experiment. This is not, the markets will see new highs. I'm not going to put a date on that. I'm not going to even attempt that, but the markets will see new highs, and we have protected your cash flow that you need in the next 12 to 18 months if you're retired, even more than that. We have that money protected within your portfolio. So sleep well, sleep tight. Turn the news off if it's causing your blood pressure to go up, and call us anytime for perspective or to talk through specific questions on your specific set of circumstances. Thanks so much. Again, it's Wayne from Visionary Wealth Management. Thank you so much for the opportunity to serve you and your family, more so even during these challenging and stressful times. Take care.